Have you ever wondered how some investors seem to make their wealth grow without much effort? It's not magic, but rather the power of dividend investing and the snowball effect. If you're ready to learn how you can potentially turn a modest investment into millions over time, stick with us. Welcome back to our channel. Today, we'll talk about the art of dividend investing and how it can create a snowball effect on your wealth. We'll cover what dividend investing is, how it works, and reveal the secrets to maximizing this strategy. But before we dive in, if you find our content valuable, hit the like button and subscribe to our channel for more insightful videos. What is dividend investing? Let's begin our journey with the basics, an understanding of what dividend investing truly is. At its core, dividend investing is an investment strategy that involves buying shares in companies that distribute a portion of their profits back to shareholders. These payments are known as dividends. What makes dividends so attractive to investors? Well, they provide a steady stream of income outside of any potential capital gains. This means that even if the stock price doesn't rise, you're still earning money on your investment. For some investors, particularly those nearing or in retirement, this can be a critical source of income. But what happens when you don't need the income right away? That's where the true power of dividend investing comes into play. Instead of taking the cash, you can choose to reinvest these dividends, purchasing additional shares of the company. This decision amplifies your investment over time and is the cornerstone of the compounding or snowball effect. For clarity, let's break down the mechanics of dividend reinvestment. Suppose you own 100 shares in a company that pays a yearly dividend of $1 per share. Over the year, you'll receive $100 in dividends. Now, if you choose to reinvest these dividends, and let's say the current share price is $25, you will effectively buy 4 additional shares of the company without investing any extra money out of pocket. Next year, you won't be paid dividends for 100 shares, but for 104 shares, leading to even higher dividends and thus more shares when reinvested. This cycle continues year after year, creating a snowball effect of increasing dividends and share ownership. But why is reinvestment such an essential part of dividend investing? Well, it's because reinvesting dividends enables you to leverage the power of compounding. Compounding is the process where the returns on an investment earn their own return over time. It's not merely growing, it's growing at an increasing rate, much like a snowball that becomes larger and rolls faster as it descends a snow-covered hill. Now let's address a vital question. Does every company pay dividends? The short answer is no. Companies that pay dividends are typically established and profitable, often in more mature industries. Newer or high-growth companies often choose to reinvest all their profits back into the business to fuel further growth. Therefore, when opting for a dividend investing strategy, it's crucial to consider the company's history of dividend payments. A consistent track record of maintaining or increasing dividends can be a good sign of a company's financial health and its commitment to returning profits to shareholders. Dividend investing is not just about receiving periodic payments. It's an approach that, when applied correctly, allows for strategic reinvestment, leading to exponential growth in the value of your investment over time. The key lies in understanding the power of compounding, choosing the right companies, and remaining patient. Remember, investing is not a sprint, but a marathon. By the way, if you're still new to investing, you can check our video that is suitable for the ultimate beginners. Check the link in the description box. The power of the dividend snowball effect. Now that we've grasped the concept of dividend investing, let's delve into the heart of the matter, the dividend snowball effect. Just as a small snowball rolls down a hill, gathering more snow and gaining size and speed, your dividends, when reinvested, can grow your investment substantially over time. When you reinvest your dividends, you use them to buy additional shares of the company. This increases the number of shares you own, which in turn means you'll receive more dividends during the next payout. The increased dividends allow you to purchase even more shares, further growing your dividends in the future, and so on. This repeating cycle, much like a snowball rolling down a hill and getting larger with each rotation, is aptly named the dividend snowball effect. But how does this snowball effect truly work in numbers? Let's look at a simplified example. Suppose you invest $10,000 in a dividend-paying stock that yields 5% annual dividend and grows its dividend by 3% each year. In the first year, you would receive $500 in dividends. If you reinvest these dividends by buying more of the same stock, the total investment would increase to $10,500. In the second year, with the increased dividend growth, your yield would now be 5.15%. which on your $10,500 investment would amount to roughly $541 in dividends. Reinvest this, and your total investment grows again. Repeat this process year after year, and your original $10,000 investment would grow substantially purely from reinvesting dividends. Over long periods, the compounding effect becomes even more pronounced as the dividends accumulate and get reinvested. The rate of growth in your investment can escalate significantly, leading to what can truly be described as a snowball effect. Now, let's consider the impact of market volatility on this snowball effect. Stock prices go up and down, and there will be years when the price of your chosen stock may fall. However, if the company continues to pay out dividends, the reinvestment of those dividends can buy more shares when the stock price is low. This means when the stock price recovers, your investment can see an even more significant rise. This is an additional advantage of the dividend snowball effect, often overlooked, that can supercharge your investments during market downturns. To fully harness the power of the dividend snowball effect, patience is crucial. The compounding magic takes time, and the true potential of reinvested dividends reveals itself most dramatically over the long term. The snowball effect isn't about doubling your investment in a year. Instead, it's about consistent, robust growth over many years, even decades. A dividend snowball effect can be a powerful force for wealth creation. By reinvesting dividends, an investor can dramatically increase their number of shares and thus future dividends, creating a self-feeding loop of increasing wealth. If you're someone who can stay the course and stick to an investment strategy for many years, the dividend snowball effect could be an excellent approach to consider. As we move on to the next section, if you're finding this content useful, please hit the like button to let us know. We appreciate your support. How to get started with dividend investing and harness the snowball effect. So, how do you get started with dividend investing and put this powerful snowball effect into motion? The first step lies in choosing the right companies to invest in. As we mentioned before, not all companies pay dividends, and the ones that do are often well-established firms with a history of profitability. When selecting these companies, a few key factors need to be taken into consideration. First, look at the company's dividend yield. The yield is the annual dividend payment divided by the stock's price expressed as a percentage. It essentially tells you how much bang for your buck you're getting in terms of dividends. However, a high yield is not the only parameter to consider. It's equally important to look at the company's history of dividend payments. Companies that have consistently paid dividends and have a track record of increasing those dividends over time are particularly attractive for dividend investors. Next, you want to ensure the company has the financial strength to continue paying dividends. Analyzing factors such as earnings, cash flow, and debt levels can provide insight into the company's financial health and its ability to maintain or increase dividend payments in the future. Once you've selected your dividend-paying companies, it's time to start investing. You'll purchase shares, then wait for the company to distribute its dividends. However, instead of taking the dividend payment as cash, you'll choose to reinvest those dividends, purchasing more shares. To do this, many brokerages offer a dividend reinvestment plan, or DRIP. DRIPs automatically reinvest your dividends back into the stock, often without any additional fees. This makes the process of harnessing the snowball effect incredibly simple and efficient. Remember, patience is paramount. It's not about short-term gains, but the long-term accumulation and reinvestment of dividends. As famed investor Warren Buffett once said, "Our favorite holding period is forever." Buffett's own company, Berkshire Hathaway, is well known for its long-term, value-oriented approach to investing. Finally, as part of your strategy, diversification should not be ignored. By spreading your investments across a variety of dividend-paying companies across different sectors, you can reduce risk while still benefiting from the power of the dividend snowball effect. Getting started with dividend investing and harnessing the snowball effect involves careful selection of dividend-paying companies, reinvesting the dividends consistently, and having the patience to let the power of compounding do its work over time. Risks and considerations in dividend investing. It's important to consider the risks and considerations associated with dividend investing. Like all investment strategies, dividend investing is not without its potential pitfalls, and understanding these can help you navigate your investing journey more effectively. One of the key risks is the potential for a company to cut or eliminate its dividend. While companies that have a history of consistently paying dividends are often seen as less likely to do this, it's not impossible. A company facing financial difficulties may reduce or eliminate its dividend to preserve cash, a move that could have a significant impact on your dividend income and potentially the company's share price. Another risk lies in the potential for overconcentration in dividend-paying stocks. As attractive as dividends may be, it's essential to maintain a diversified portfolio. If you're heavily invested in dividend-paying stocks, particularly in specific sectors, you may be exposed to sector-specific or market-wide risks. Diversification across different asset classes, sectors, and geographical regions can help mitigate these risks. Furthermore, it's crucial to be aware that a high dividend yield can sometimes be a red flag. A company with a yield significantly higher than its peers may be facing challenges, and the high yield may be unsustainable. It's always essential to look beyond the yield and understand the company's overall financial health and the sustainability of its dividend payments. Finally, it's important to remember that tax considerations can impact the net return from dividends. Different countries have different tax treatments for dividends, and these can significantly impact your net return. It's always a good idea to understand the tax implications of your investment decisions. The power of dividend investing and the snowball effect can truly be transformative for your financial journey. By choosing strong, dividend-paying companies, reinvesting the dividends, and allowing the magic of compounding to work over time, you're not just investing. You're building a growing stream of passive income that can potentially support your financial needs and goals. Remember, dividend investing is not a get-rich-quick scheme, but rather a long-term strategy for wealth accumulation and preservation. The dividend snowball effect is a testament to the power of patience and consistency in investing. And as we've seen in our examples, over time, the effect can be substantial. If you enjoyed this video and found it informative, don't forget to like it and subscribe to our channel for more valuable investment insights. Remember, the path to financial freedom is often through consistent learning and taking informed actions. If you want to learn more about investing, you might want to check out the Summary of the Intelligent Investor by Benjamin Graham. Link is in the description box. Thank you for watching. We'll see you in the next one.